So, you ever wonder how these huge companies or even entire governments get their hands on billions of dollars? Well, a lot of the time the answer is bonds. They are an absolutely fundamental part of the financial world. And in this explainer, we're going to pull back the curtain and show you exactly how they work. It all starts with a really simple idea.
At its heart, a bond is a surprisingly simple concept, right? Imagine you lend a friend some cash, and they write you an IOU, a simple promise. Now, what if you could turn around and sell that IOU to somebody else? Well, that's pretty much the basic idea behind a bond. It takes that simple promise to pay back a loan and turns it into something you can actually buy and sell on the open market.
And this really gets to the core of the deal. See, on one side, you've got the issuer. That's the company or government that needs money. On the other side, you have the investor. And hey, that could be you who provides the cash. So when you buy a bond, you're literally lending your money in exchange for a promise that they'll pay you back with interest.
Okay, so to really get a grip on bonds, you gotta know the lingo. Let's break down the key pieces, the essential vocabulary that makes a bond, well, a bond. First up is what we call the nominal value. You'll also hear it called face value or principal. It's just the original amount of the loan. So if a bond has a nominal value of, say, $1,000, that's the amount the issuer promises to pay you back when the bond's life is over. Think of it as the anchor for the whole deal. Next, we have the coupon. This is the fun part. It's the interest you get paid for making the loan in the first place. It's a fixed percentage of that nominal value we just talked about. And it's paid out regularly, maybe every 6 months. So for our $1,000 bond, if it has a 5% coupon, you're going to get $50 in interest every year. It's your reward for lending them the money.
So, how do you get your original $1,000 back? That's what amortization is all about. Does the issuer pay you back all at once, right at the very end? That's called a bullet payment, and it's the most common way. Or do they pay it back in little pieces over time? The amortization schedule just lays out that whole repayment plan.
Okay, now this is where it gets really interesting. Because while that nominal value and the coupon are set in stone, the bond's price is not. The price is what that bond is actually worth if you wanted to sell it on the market today. And after it's first issued, that price can go up, it can go down, and that leads us to probably the most important concept in the whole world of bonds.
All right, if you only remember one thing from this whole explainer, please make it this. It's the relationship between a bond's price and the actual return you get. I want you to think of it like a seesaw. When one side goes up, the other side has to come down. This is the key dynamic, and you absolutely need to get it.
So on the one hand, you have the coupon rate. It's fixed, right? It just tells you the dollar amount of the interest checks you're going to get. But on the other hand, you have the yield to maturity, or YTM. This is the real number. It's the total annual return you'll actually earn if you buy the bond at today's market price and hold it all the way to the end. It's the true measure of your return.
And here's the bottom line. It's an inverse relationship. If you buy a bond for less than its face value, you get it at a discount, your actual return, your yield, is going to be higher than that coupon rate. And you guessed it, if you pay more for it, at a premium, your yield will be lower. It's that simple.
And check this out. This visualizes that seesaw just perfectly. This is data from a real bond, from the Mexican oil company Pemex. On the vertical axis, you have the price, and on the horizontal, the yield. Just follow the curve. You can see it plain as day. As the market price drops, the real return, that YTM, just climbs and climbs. They move in perfect opposition to each other.
Let's make this real. That Pemex bond had a fixed coupon of 6.35%. Not bad. But on one particular day, you could buy it for just 86.6% of its face value. So because you paid less for the exact same future payments, your actual yield to maturity wasn't 6.35%, it was this, 7.62%. That is a much better return, all because the market price went down. Up until now, we've been looking at this from the investor's point of view, right? As a way to get a return. But let's flip the coin. What does all this mean for Pemex, the company that issued the bond? For them, that yield isn't a return at all. It's a cost. For the company, that yield to maturity we just figured out is the most accurate way to measure what it costs them to borrow money. It tells them what interest rate the market is demanding right now to lend them cash. That original coupon rate, that's just history. The YTM is today's reality. And that's exactly why financial analysts, when they're figuring out a company's cost of debt, they pretty much ignore those old coupon rates. They look at the yield to maturity on the company's bonds that are out there trading right now.
The YTM reflects everything the market is thinking about the company's risk, about the economy, everything. It's the best guess of what it would cost them to borrow money today.
But, of course, a higher yield usually means higher risk. That's just how finance works. No investment is a totally sure thing, and bonds are no exception. So let's look at the other side of that nice high yield. What could actually go wrong?
You've really got 4 main risks to keep an eye on. First is credit risk. That's the simple chance the company just can't pay you back. Then there's interest rate risk, which is the danger that shifting rates will mess with your bond's value. Third, you've got inflation risk, the chance that your fixed payments will buy you less and less stuff over time. And finally, liquidity risk, which is just the risk you can't sell your bond when you want to without taking a big hit on the price.
So let's start with the big one, credit risk. How in the world do you know if a company's going to pay you back? Well, that's where these credit rating agencies come in. You've probably heard of them. S&P, Moody's, Fitch. They're like the scorekeepers. They analyze companies and give them a grade, from super safe AAA all the way down to D for default.
And this chart right here shows you exactly why those ratings are so critical. It maps out the actual historical chance of a company defaulting based on its credit rating. Look at the bottom. The AAA-rated companies almost never go under. But as that rating gets worse, whoa, the probability of default just skyrockets. A lower rating means a genuinely higher risk.
Now, interest rate risk is a bit tricky because it can get you coming or going. On one side, you have price risk. If new bonds start getting issued with higher rates, your older, lower rate bond suddenly looks a lot less attractive, and its market price will fall. But then there's reinvestment risk. If market rates fall when you get those coupon payments, you have to reinvest that cash at a lower return. So you're kind of exposed whether rates go up or down.
So, we've covered what a bond is, that all-important seesaw between its price and its yield, and the big risks you face. And all of that leads to the fundamental question for any investor, really. Knowing that higher returns almost always come packed with higher risk, how do you decide what kind of return is actually high enough to make it all worthwhile?